Let's ask Victoria Greene, G-Squared Private Wealth Chief Investment Officer, also a CNBC contributor, and with me right here at Post 9. Welcome. It's good to see you in person here.
Thanks,
you describe yourself as a reluctant bull, though it was like 2 weeks ago, not even, that you said we're in the beginnings of a new bull market.
I know, and I'm so reluctant to say we're in a bull market, but you can't ignore what the technicals have done. If you look at where we put in potentially a lower, a higher high and a higher low, and when we look at the markets, we look at the tape, you got to look at this and say, hey, we're holding here. We're holding at the 200-day moving average. We're holding at the retracement levels. We're holding that new potential uptrend, downtrend line, and so you can't fight the tape on this one. And earnings, most likely, we are going to see revisions start to kind of go positive. We think earnings revisions are going to bottom out here in Q1. And then once earning revisions bottom, which we've seen right now, they're holding water in February.
You're calling for a trough in earnings right where we are now.
I am, a little bit. I know. It's scary. It's scary. I get it. We don't have the fundamentals necessarily to support it, but everybody hates the beginning innings of a bull market because it makes no sense whatsoever. There's nothing really supporting it on the fundamental or the macro side.
It feels like the bullish case is like the talking points around it are much harder, right? Positioning is not what it was to start the year. Hedge funds aren't really giving you a bid right now. And I would say even technically, right, we're watching S&P as we're having this conversation. Gave up 4,000. We broke the 50-day. It's not like the multiple on the market is cheap either.
Never got super cheap. But I remember a couple months ago we were talking about this when we were in the bear market, and you said, well, can the market rally without tech? And the answer was no. Obviously, you can't rally without the big cap, mega cap tech. But now, can you have a bear market if tech is rallying? And I don't think you can. And right now, there's a lot of reason, a lot of momentum behind mega cap tech rallying. And so I think it's almost the inverse of what we saw in October when markets were coming down. You couldn't fight it with the big cap falling apart at the end of Q4, but now tech is what's leading us out, and it's the same thing. Don't fight this bull market. Don't fight these mega cap leadership.
Okay, now I want to bring up something that dropped just a little while ago. Okay, it's from Marco Kolanovic over at JPMorgan, right? He's one of their big strategists there, and when he talks, people pay attention, and it has had at a time the tendency to move markets. I want to read you what he wrote because I want your reaction to it. It kind of flies in the face of what you're arguing, which is fine for a debate. History implies that for the current level of real rates, the S&P 500 multiple is 2.5 times overvalued. Higher for longer rates create negative externalities, including demand destruction, lower margins, higher interest costs for leveraged assets, especially real estate and small caps, and asset write-downs and credit losses. As such, risk-reward for equities remains poor in our view, reinforcing our underweight equity stance. This is from somebody who was bullish for longer than most until he saw the writing on the wall.
And I get that. You are fighting some macro headwinds. Without a doubt, if you were to look at the technicals, the fundamentals, and the macro headwinds are huge. And you're looking at that inflation looks entrenched. And I get that there are problems there, but the consumer hasn't broken. Everybody's waiting for the consumer to break. When is consumer spending going to break? When are we going to see unemployment break? It hasn't broken. So I look at some of this and say, they're expecting this to roll over and die, and equities and the econ have been stronger than anticipated. I call it a Teflon market. When you look at it, yes, we are expecting the consumer, the spending and income ratios haven't been where we want to see them. But if the consumer doesn't break, you're not going to see these things happen. And the consumer has been extremely strong. And so I'll bet on the U.S. consumer.
But how do you counter what he calls this bond equity divergence, right? You've had rates move higher.
Sure.
And for the most part, stocks have yawned until now.
Until February, yes. And then we saw the correlations increase. One, I think the dollar is still going to roll over. And if you look at the headwinds, yields coming back up, dollars coming back up in February, we went back to trend. And that was back to 2022 trends. But I think if you look at this, a lot of it, I would say, is more dollar than yields, because the dollar comes back down. That helps everybody and multinationals. And yeah, I do think yields, we're testing, but we couldn't get back above 4 on the 10-year. That ceiling held. So I don't think necessarily yields are going to go higher. And I get the yield curve inversion. I understand that looks really, really ugly. But I think if you step back, you realize that there are a lot of positives in some of these stocks, and I'm not going to fight a mega cap tech rally.
But how do you make a credible case now that, and let's just go with the bond idea.
Yep.
How do you make a credible argument right now that stocks are more attractive than bonds, for example?
We're not. We're long bonds. We think bonds are going to have a good year. We think this is a great year for fixed income. We like the treasuries. We like some of the credit. I think credit spreads are a little narrow right now to load into credit. But I think there's going to be a time and a place for duration. I do think equities are attractive, but I think you want to maybe look a little bit growthier because you aren't getting paid your dividend yield on the S&P 500 well below the 10-year Treasury. But I think you're going to see these rallies happen. I'm not saying throw it all in. I'm not advocating that this is, going to be a stampede. I'm just saying I think the lows are in, and I do think this could be a decent year on the market. Doesn't mean we're not going to have corrections at all or consolidations like February. We may see a little stumble here or there.